Hello, it's great to have you back here at pennystockanalysis.com for another great short video session teaching you how to become a better investor. So without further ado, let's get on with the lesson from pennystockanalysis.com. Along the same lines as the last session we had together, which was about being chill, be focused, and be aware, now it's time to really hone down what focus means, and this means to focus on your portfolio, which is what today's lesson is about. There's all different types of strategy, whether it's the dogs of the Dow, buy and hold, or short-term investments, do you want growth stocks, dividend stocks, and so on and so forth. So here is just a very broad-based recommendation that should easily be able to fit within the parameters of all of your insight into what's best for your situation. Since we have found that people remember things best using the number 3, I guess there must be something rhythmic about it. That's what we're going to do today. We're going to talk about things in sets of 3. So here are 3 things that you should know about your portfolio. And these are just suggestions. During good times, it's wise to have 90% of your money invested in the market and have 10% in cash. You ask why the 10% in cash? It's because you never know when you may have to cover margin if that's what you choose to use to amplify your investment buying power, or maybe you have to sell your stock and the fees might be a little more than anticipated, or maybe you just come across an opportunity and you just want to dump a little bit of money into it. So you never know, sometimes it's worth it to take a flyer. So 90% of money invested, 10% in cash during good times. Number 2, we suggest having your portfolio split into 3 categories. So there's growth and value stocks, there's dividend stocks, and there's risk-taking stocks. That'll be the focus of our next slide. And number 3, evaluate things at least once per week. You know, it takes a little bit of effort into really building a small fortune on the market, and that's the same as it takes to have a good diet and good exercise and live long. You've got to put a little bit of effort. So at least once a week. It doesn't have to be long, even 10 to 15 minutes will suffice. But look over your investments, look at new things, and if it's time to change or stick the course. As promised, we're going to focus on point 2 from the last slide, which was having your portfolio split into 3 categories. It's not necessarily about diversifying industries within your portfolio as much as it is having your portfolio set up very broadly for some nice growth. Some that you determine, some that is steady, and some that are risk-taking, which really can lead to some big return on investment. So let's get a broad-based view here. The first type is growth and value. So this should be about 40 to 50% of your portfolio. And this is any stock that you like. It's anything that you research. It's in any industry. It can be cyclical, or it can even be a hot industry at the time. A cyclical stock is something like cars. They do well during a boom. They do bad during recessions, and such they move with the cycles. So there's always like bottoms and tops that are much easily more determined when looking at those. But this is anything. You know, a growth stock is something like Apple. A value stock might be something like Microsoft if you want to keep it in the same industry, or even Intel, or Johnson & Johnson, or Kimberly-Clark. Those are all value stocks as well. So those are just an idea. It's anything you like, anything you research, and it should be 40 to 50%. In this case, you're looking for actual growth in the stock price. The next thing is dividend stocks, and we place a pretty heavy emphasis in this case of about 30% of your stocks should be paying dividends. So you want to look for companies that are more in the steady Eddie kind of company. In other words, they increase the money paid out to shareholders consistently. Their business grows consistently 5 to 10 or even 15% per year, and In this way, the money that's paid from dividends goes directly into your pocket. It's not dependent on you selling your stocks. So that's why it's great, and they're taxed at lower tax bracket than normal personal income taxes. So that's another great thing about dividend stocks. And the third area are risk-taking stocks. So this is your chance to really make a huge return on investment. So this can be done by taking a chance on new technologies, small companies, penny stocks, or even Apple in 1997 when they basically had to be bailed out by Microsoft, which is a turnaround story. So this is basically your chance where you think something is so blatantly obvious and so blatantly cheap, or it's so great that you have to invest in, and you're getting in at what may be considered a risky time for the stock or in the company. But when you take the greatest chance, there's also the greatest chance for return on investment. And chances are, in this case, with this 10% of your money, if you make 5 bets, chances are 4 might do badly, but that one will have such a huge return on investment that it should more than make up for the mistakes. So there you have it. There is a short and concise presentation about what is one possible, very broad-based view of how a portfolio can be split up. And when it's split up in this way, it will provide you with a little insulation against downfall because of the big dividend part. 10% to risk your money on growing companies, or money, in other words, that you may in fact lose. But even making that one huge gain, this is what really gives a boost to your portfolio in the short term, and if done properly, over the long term. So again, this is just one possibility, but we think it's very broad based. It covers a lot of investors' mind frames, and we think it's quite sound. So let us know your thoughts. Email us, check out our website, and from Penny Stock Analysis and PennyStockAnalysis.com, invest wisely.